But I believe that with our dedication and our resilience, our determination, we'll be able to sail through this period. A lot of us are getting agitated as the days are coming by. All right, so let's get back to work. We'll look at the 10th section on our subject on this Unit 4, speaking to procedures aimed specifically at identifying specific events. So the auditor needs to perform procedures in his field work that may be specifically tailored at or geared at identifying subsequent events. So auditors must actively search for events occurring after reporting date, but before the audit report date, that could affect the financial statements. What does that mean? He needs to, in performing procedures, even though that's not primarily why he's doing his test of details or reporting, but he needs to keep an eye. He needs to be keen on checking for events after reporting date in doing the work, in the field work. That may not be primarily why he's doing his test of details, substantive testing, but he needs to keep at the back of his mind that any event after reporting date needs to be kept aside, pointed out, noted, identified, and kept aside that, okay, this was not on the financial statement and is an event after reporting date, and it could affect and distort the actual position or performance of the company. So our auditors must actively search for such events. And the key procedures around this is that the auditor needs to understand management's process for spotting subsequent events. So are management aware? Are they equipped? Do they understand how to spot events? So he needs to understand their process of spotting subsequent events and also inquire of management about any such events. He needs to inquire about any subsequent events and also review interim management accounts. Management accounts are the process to which financial statements are prepared. So he needs to review management accounts, and that's why some of these external auditors ask you of management accounts. Aside the financial statements, they tell you to give them your management accounts. They are very meticulous about seeing the process of which the financial statements are produced. So some of these subsequent events could be identified from management accounts because they could be expunged from financial statements. So they always request that. Also, from minutes of board meetings, some of these things are discussed. Events that crystallize could be discussed at board meetings, at committee meetings. So some of these minutes are very important and auditors request for it. Also, shareholder meetings, management meetings, all of these minutes are actually being requested by auditors so they could find or identify some of these subsequent events. Also, written representations have to be provided by auditors to confirm that all events, subsequent, adjusting and unadjusting, are disclosed. Very key. So, in identifying this and helping the auditors do their work, the auditors must inquire. Like I told you, some of them do through questionnaires. They must review and verify that no subsequent posterior events affecting the financial statements are overlooked. That's just the objective, and that's very important for auditors. Okay, so let's look at the facts discovered after the date of audit report and before the financial statements are issued. What are the facts that could be discovered? Now, after signing the audit report, the auditor's responsibility reduces, but if the significant fact emerges before the financial statements are issued, the auditor must act on it. So if he has signed the report and something comes to the fore before he issues the financial statements he signed, then he must act on it. He needs to reflect that event that occurred. So some of his actions will include any event that occur after he has signed the report, but he has not issued the financial statement or the audit report he has signed. He needs to discuss the event that crystallized with management, that this has come to our attention, and he needs to determine if the financial statements must be amended before he issues the financial statements. He also needs to inquire how management plans to address it depending on its materiality. So some of these actions are what the auditor should take if something comes to the fore on any significant fact that emerges after he has signed the audit report. And if amendments are made, then the auditor need to perform audit procedures on the changes based on the amendments. He also needs to extend the review up to the date of the new audit report. But if management refuses to amend, then since the report has not been issued, or he has signed but he has not issued the report on the financial statement, then he needs to modify his opinion, because management has refused to amend that event that came to his attention. But if already issued, he has issued the management report, the audit report, and the financial statements have been issued, he needs to instruct management not to release the financial statement or publicize. And if they publish or release their financial statement, he needs to take steps based on that information that has emerged. Take steps like taking legal action to prevent reliance on the report publicly. So these are actions that the auditor could take where facts were discovered after the date of the audit report has been signed and issued. Management has refused to comply with his directive. So the key point around this is, even after signing the audit report, the auditor must respond to material post-report facts. He must respond because his integrity is at stake if some of these events are made public. His integrity is at risk. So he needs to act to maintain the integrity of that audit opinion. This is very important because a lot of stakeholders depend on that opinion. Some people will not make investments on this until they see the auditor's opinion. And if they see a valid audit firm's opinion, they just make their decision. So that audit opinion integrity must be guarded by the auditor at all costs. This is very important. So that's it about facts that are discovered after the date of the audit report and before the financial statements, or after the financial statements have been issued. Now let's look at another section on facts discovered after financial statements also have been issued. Now, once the financial statements have been issued, the auditor has no obligation to perform audit procedure. He has signed the report, the financial statement has been issued and published. He has no obligation to perform audit procedure. But if a material fact is discovered that could have affected the audit report or his opinion, then he needs to first discuss with management, then determine how the financial statement should be amended, irrespective of the audit report issued and the financial statements issued. He needs to inquire how management needs to address this material event. And if the financial statements are amended, then he can perform audit procedures on the amendment. He can also extend review of those subsequent events that came to his attention to the new audit report date he needs to review. He also needs to check that management inform users of the original statements that this is what has come to their attention and we are reviewing our report based on this. And we need to issue a new audit report, including an emphasis of matter. We need to include an emphasis of matter based on this new emergence and this new event or other matter paragraph to additionally include what has happened to the previous opinion. So these are the actions, very important. So please take note of it. And we'll come to some of these details like Kachi asked in events in reporting, chapter 14. Yes, please, AA. Your hands are up. Please go ahead.
Okay, sir. Sir, please, I'm just trying to get this clearly. In terms of this action that needs to be taken by the auditor, must it be in this sequence? Because as I'm thinking through, I'm thinking the number two should come before number one, in the sense that you determine the how it will impact on the financial statements before discussing with the management. And but I'm just trying to see, is it going to be in this sequence if we have a question like this?
Fantastic question. Thank you very much for that. So discussing with management has nothing to do with the materiality of the event. So when something comes to his attention, he first needs to discuss with management, immaterial or material. So get that first. So discussion with management is the first action. Then he will now determine, after management has conceded to agreeing that, okay, it happened, we agree. So that discussion is to align that, CEO, so this has happened though. It just came to my attention. Manager, oh, really? Okay, fine. Then he will now determine, okay, should the financial statements be amended or not? So that's the first thing, is to bring it to the fore. Then amendment is after. Amendment cannot come before discussion, because every issue that comes to the attention of management, to the auditor, has to be brought to the attention of management, whether material or immaterial. That's the first thing, the first action the auditor should take. If 1 naira is stolen, he has to call the attention to it. If 1 billion is stolen, he has to call the attention to it. Then he will now determine whether there's adjustment or not. So that's it. So let that sequence follow first. Discussion with management, then determination of amendment or adjustment. I hope that's clear.
Yes, sir.
All right. Thank you. Good question. Good question. So where management intends to address whatever he brings to the fore, the financial statements, it's good to go. That means they are cooperating with the auditor. He needs to do whatever he needs to do around performing audit procedures on what has been brought to his information, or extend another review, or to amend his report based on the information that has been brought to his attention, or is this new discovery, to include a new audit report, and also communicate with management and how they should give also the users of the initial report that was provided, and what has come to his attention, and what he has added, speaking to emphasis of matter or other matter paragraphs. So an example of some issues that may come up after the audit report has been signed, the financial statement has been issued or even published, are receivables. He needs to check recoverability if a major customer enters receivership. Let's say a major client, a contract client of the company he's auditing, went into receivership, talking about bankruptcy, and that receivables is going bad, and it has not been reflected in financial statement that has been signed. That may need to be reflected. It needs to be amended. Also, inventory, high value inventory around, he needs to assess net realizable value for goods made to the customer specification. So where there are material inventory that could distort the actual position of the financial statement and is brought to his attention, these are examples of amendments that must be made. He needs to evaluate the reasonableness of any proposed write-downs, whether in assets, liabilities, or any obligations in the position statement of the company. And if management refuses some of these adjustments, he needs to consider the impact on the audit report and communicate appropriately with shareholders. If these events are material and management says it doesn't matter, or they refused, or they are obstinate in adjusting, then he needs to communicate to shareholders on some of these material happenings. And he could do that at the annual general meeting. So the key point around this is the priority, the immediate priority. He needs to ensure that shareholders, users are informed. After audit reports have been issued, financial statements are already published, he needs to say, hey, this has come to our attention, and it could affect the decision you make based on your investments and your stake in this company. And he also needs to consider audit resignation if necessary, especially where management has refused to cooperate appropriately based on these findings. So that's it about facts discovered after the financial statements have been issued. All right, so we ran fast on those 12 long sections. The slides have been provided on the group, the PDF format. So please, you can follow through as we run. I think we are going to the final unit. I want us to see if we can close before 10. Let's run and close before 10 so that we can rest, because this weekend is going to be quite it will be quite engaging for us. I want us to look at the past questions for this on Saturday, and also look at group accounts. Let's see if I can finish group accounts and group accounts, group audits. I beg your pardon, group audits and the past questions, so that by Monday we now face pilot question and answer pragmatically. Let's start preparing for exam. Anywhere we finish the pilot, we can see if we'll cover the remaining 6 chapters. If we don't, then I'll just provide materials for us to read. So that's the plan. So let's look at Unit 5, going concern, very important, and the guide is ISA 570. So by way of introduction, you must understand that financial statements are prepared assuming that the entity will continue operating for the foreseeable future or for a foreseeable future, and the sustainability of a business to operate in perpetuity is very important for the auditor to assess. So we are not just looking at numbers. You're not looking at the now. You must be futuristic as the auditor in the approach of audits. You have to ensure that a business is sustainable and a business provides value in the long run. So you're not just auditing 1 year financial statement, 2 year financial statements. If there are problems, you need to bring them to the fore. And that's what the going concern concept is about. So the implication, if the company is not a going concern, is that the current versus the non-current distinction disappears. Talking about assets, liabilities are treated as current. So financial statements that are prepared based on the going concern concept needs to facilitate this. And assets carried at net realizable value shows that the company is not a going concern. Also, any possible additional liabilities around their disclosure and the auditors finding this shows that a company may not be operating as a going concern. So his responsibility is to assess whether the going concern assumption is appropriate and it's applied to the financial statements. He needs to also investigate financial and operational position before year end on that company. The auditor also, if he doubts these issues, need to consider investigating further and check the implications of these going concern issues on the financial statements. This is very important. So that's generally the going concern concept, which is one of the cardinal pillars of accounting. A company should be able to operate continually in the foreseeable future. All right, so going concern duties of directors. Going concern, speaking to the duties of directors. Now, the management of a company have the primary responsibility to ensure that going concern basis is appropriate when preparing financial statements based on IAS 1. Very soon it's going to be replaced by IFRS 18. Is it IFRS 18 now or IAS 18? It will soon be replaced. I think it will take effect from 2027, January. I think it's IAS 18. Somebody should remind me now. Is it IFRS 18 now or IAS 18? The corporate SBR student, 18. Remind me. IFRS 18. Thank you. So IAS 1 is going to be replaced by IFRS 18 by January 1st, 2027, if I'm correct. So the going concern basis is appropriate when preparing financial statement, and this needs to be validated by the auditor, and the director's responsibility primarily is their job to do this. And the disclosure requirements in some jurisdictions around large listed companies must state in the financial statement that, in their opinion, the entity is a going concern. Even in our jurisdiction here, our principle-based jurisdiction, we are to auditors are to, in their financial statement or their opinion, state that the entity is actually a going concern. Because the key point here is that management and directors assess going concern. That's their primary responsibility, not the auditor. The auditor can only review going concern, but management should assess it and report on it. This is very key. And that's the going concern duties of directors. Now let's look at the going concern duties of auditor as guided by ISA 570. So in assessing the going concern of a company, the auditor needs to gather sufficient appropriate audit evidence that management's use of the going concern concept or assumption is appropriate and relevant to what they've prepared as their financial statements. This is very important. So the objective of the auditor is to gather his evidence based on this. He also needs to conclude whether material uncertainties exist that may cast doubt on the entity's ability to continue as a going concern. So, for example, he's seeing consistent losses Those are doubts that he needs to bring to the fore. Okay, how are you addressing this loss? Last year, you made your bottom line, your net, instead of net profit, net loss. This year, I'm seeing net loss. These are triggers. These are signs. These are symptoms. So anything that would cause material uncertainties about the company's going concern status needs to be brought to the attention of management. So, like I said, net loss consistently, if it's a startup, is understood. Especially for a commercial company that is primarily into business for profit, the auditor needs to identify this and bring to the fore of management. He also needs to determine the impact of these uncertainties on the audit report. He needs to determine the impact on the audit report. Somebody trying to speak, please, if you're not speaking, can you mute, please, so we don't get distracted. If you want to speak, let me know. Thank you. All right. So I was speaking to, I think I lost my thoughts. Yeah, I said determine the impact. He needs to determine the impact of those going concern uncertainties on the financial statement on his report. So key steps the auditor should perform is to perform risk assessment for events and conditions that may threaten the going concern status of the company. So risk assessment around the FS, the numbers, the components, like I spoke to a major component on net loss, continuous net loss, and revenue generation issues. And he also needs to perform steps. Yeah, please pardon me. I was logged out. I think my network glitched a bit. One of those challenges of virtual platforms. Please pardon me. Please, can you confirm you can hear and see my screen, please, so we can continue?
Yes, sir. Loud and clear, sir.
Okay. Thank you. Sorry about that short cut off from the meeting. All right, so I was speaking to performing risk assessments around events or conditions that may threaten a company's going concern. And the auditor has to ensure that management has assessed the going concern issues of the company, and he also needs to discuss the assessment with those charged with governance. He also needs to check whether relevant events and conditions were identified by management, and also evaluate management's plan to remediate, resolve, and mitigate these issues. So if management has not assessed any going concern issues, then he needs to discuss the basis for assuming the company will continue on the going concern basis. He also needs to inquire about events and conditions that may raise doubt based on the figures, based on conditions of the company, based on results, based on activities he has seen in the company's FS, and bring them to the fore. So the time frame for this is he needs to consider at least 12 months from the reporting date if the company will continue. 12 months from the reporting date. And the time frame also speaks to checking if management is aware of relevant events beyond this period that could affect the going concern status of the business. This is very key. So factors indicating potential doubt could be financial factors. So for example, net liability, current liability position, negative cash flow issues around operational investing and financing activities, operational losses, net losses, adverse ratios and results, inability to pay creditors or comply with loans or their repayments, dependence on short-term borrowing to pay salaries or some other short-term obligations. These are indicators of going concern issues that could be financial, and some of them could point to sustainability challenges the company is going through, and the auditor needs to bring them to the attention of management. Could also have operational issues around loss of key management staff. For example, the MD or the CFO resigned and there's no plan to replace such key positions. There are operational issues that could halt the going concern of a company. Major customers or suppliers not providing materials or services to the organization, labor issues, strikes, action by maybe staff union and all that, critical supply shortages for production or manufacturing, liquidation plans, failure to finance essential operations are operational factors that indicate potential doubt on the going concern of a company. Others could include legal disputes, regulatory proceedings, changes in law and policies, uninsured disasters that are material or significant that had hit the company. These are going concern issues that could bedevil the company. So these are the going concern duties of the auditor. His duty is to review what management has assessed, review and confirm that, okay, the assessment in his opinion is okay, because going concern is very important. Now let's look at the next section on going concern assumption. What are the audit procedures the auditor should perform? So when events and conditions may cast doubt, the auditor needs to perform additional procedures to gather sufficient appropriate audit evidence. And when he has doubt around this, he needs to discuss with management and those charged with governance on his doubts. And some triggers, some of these doubts may be triggered by some of his findings, disturbing findings in the financial statements. He also needs to understand why management believes going concern is valid as against his facts and findings. He needs to discuss with them, understand how come from what I'm seeing, the KPIs, the CSFs that are red, you are saying is green. He needs to understand why. He needs to discuss their future plans, the expected losses and their impact on the AFS. What are their future plans? How do they expect to remediate some of the issues he has found, or that are indicators based on the financial, the operational, and other factors that are very clear and glaring based on his findings. So the first one is to discuss with management. The number two is to look at cash flow forecast. He needs to obtain and review forecast for at least 12 months from the reporting date to validate that the company can meet short-term and long-term obligations. He needs to also challenge assumptions and discuss plans for any cash shortfalls, because the company needs cash to operate, and cash flow is very important. And he needs to review other areas around sales day books or sales order book, check for declining orders, check for aging receivables, longer payment periods, bad debts, expected credit losses, which may affect cash flow. So aside discussing with management, he needs to check cash flows, obtain and review them. He needs to also review other areas around sales and aging of receivables. He also needs to check capital expenditure plans. CapEx, he needs to ensure CapEx are adequately provided, adequately purchased, or purchases are based on budgets to ensure adequacy of continued operations. He also needs to check key personnel departures. Like I said, I gave an example of the CEO or CFO, key positions, and he needs to consider the impact on customers and the business. He needs to check court cases, litigations, and assess potential liabilities the organization could face. He also needs to check bank support by confirming financial availability or finances available for the business if the business relies on banks. He also needs to do this by written representation, obtaining a letter from management confirming their opinion on the going concern assessment they made. Also, communication with management's view on conflicts with auditor's assessment based on going concern. He needs to communicate that this is our assessment and this is your assessment. But both of them are not in sync. They are not syncing. How do we address this? What we assess is different from what you had assessed. And he needs to discuss with management and also gather additional evidence by way of written representation based on the conflicting results of both management and the auditor's assessment. He also needs to persuade management to revise statements, if necessary, around the assessment and the going concern issues that are discussed. If there's disagreement on the going concern status, management is saying the company will continue. He is saying from what he has seen, the company is in the red. Then he needs to consider qualifying his opinion. because management cannot be saying another thing and his result and finding is saying something different. He also needs to communicate material uncertainties to those charged with governance, talking about shareholders and the owners of the company, which includes the nature of events and conditions that his results and findings have come up with. The appropriateness of going concern assumptions needs to be communicated. He needs to also communicate the adequacy of these disclosures to them. And areas around delay in approval, if delay due to going concern issues and performance of additional procedures and assessing impact on the audit conclusion is eminent, then the auditor needs to ensure that if management does not approve, he needs to consider his position on some of the issues he has discussed with management, either by qualifying the opinion or by a disclaimer of opinion or something that he shows there are issues that needs to be addressed and not just providing a clean report on the audit here. This is very important. So the going concern assumption needs to be tested by audit procedures and ensure that they are valid based on what management has assessed. Okay, so if we don't have any question, we're on to section 5 on the International Audit and Assurance Standard Board's alert on this issue. There are audit considerations in respect of going concern in the current economic environment. So the IASB, based on current happenings, have issued to auditors some very clear alert on what to look out for on going concern issues of companies they are auditing. And the purpose is to remind auditors, management, and those charged with governance to carefully evaluate the going concern assumption during periods of credit crisis and economic uncertainties. So these going concern issues are very serious and critical issues that must be assessed carefully. And the key points from that IASB alert is that, number one, the going concern assumption is a fundamental accounting principle, very fundamental in preparing financial statements, is very key. Number two is that management is responsible for the assessment, and the entity's ability to continue as a going concern is primarily the responsibility of management. Secondarily, the auditor must evaluate the appropriateness of management's use of the going concern assumption on every audit. So these are the responsibilities of the auditors. And number 4, ISA 570 on going concern provides the requirement and guidance for auditors in this area, and it includes reporting responsibilities on going concern. So the credit crisis and economic downturn around going concern issues may lead to, number one, lack of credit around liquidity challenges a company may be facing and business disruptions due to either natural disasters or some act of God or something, all of which affect the entity's ability to continue as a going concern. So auditors must therefore critically and objectively evaluate management's forecast and assumptions around these going concern concepts. And the extent of disclosures in the financial statements depend on management's assessment of the going concern status and also the disclosure requirements under the applicable financial reporting framework, which is IFRS 18, which is the new one coming up, and IAS 1. So the disclosure requirement for going concern status must be applied appropriately. IFRS 18 will replace IAS 1, like we said earlier, and this needs to be integrated. So for exam-focused question, because this area the examiner really tests most of the time, when economic conditions are certain, auditors should increase their professional skepticism. That's how you should write such answers around going concern issues. You need to seek robust, appropriate audit, sufficient, appropriate audit evidence, and ensure adequate disclosure of material uncertainties in the financial statements around going concern issues. So that's the IASB alert on this challenge, and it was integrated into ICAN's study text to alert students on the importance of going concern concept and how auditors should be able to review going concern assumptions of management. All right, so that will be the end of the going concern concept and the going concern review by auditors based on ISA 570. Yes, please, Grace, your hand is up. Please go ahead.
Okay, so sir, having known the procedures the auditor should do on going concern entities, what are the procedures an auditor should do when auditing an entity that is not a going concern? I mean, is disclosed, the management agree, this is not a going concern, we are breaking up. What and what should the auditor do? Will there be need for even auditor? Or if there is need, what are the procedures expected of an auditor in auditing a breakup entity?
All right, I think we'll be coming to chapter 12 on bankruptcy, where we'll talk about breakup basis, liquidation, and all that. But before we come to that, I'll just answer that briefly. And the answer is that where a company is not going, continuing as a going concern, then, like you said, then they don't need an auditor. So they are talking about winding up now. They're talking about bankruptcy and liquidation. So they will not need the auditor to do that because they've arrived at a decision to cease, called cessation of business. So the business is going to cease or is not going to exist anymore. So there's no need for the auditor then. All you're looking for is a receiver or a liquidator to share the assets, the liabilities of a company, and that's it. So the procedure doesn't matter. So the quest for going concern is that you are seeing that the company is going down or is going to halt. And management is saying the company is going to continue. And you, from the indicators, the factors you are seeing, the company cannot continue. So you are arguing that management, this is what I'm saying. But you are saying the business is sustainable. But I'm not saying it as sustainable. So that's the question on the ISA 570 ongoing concern. But in answering your question succinctly, where a company has decided to not continue as a going concern, they don't need an auditor. He will issue his report and say, okay, the company is no longer, management has confirmed in writing that they are no longer going to continue in business. Maybe this is their last financial year. So they are going to appoint a receiver, blah, 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 a liquidator to end the business. So like you said, they don't need an auditor to continue or to close down the business. The auditor is not needed to provide services on distributing assets or shutting down the business. It's a receiver or a liquidator that will be needed to do that. Okay, so I hope you got some thoughts on that. Yeah. All right. You're welcome. Yes. Okay. So AA, your hand is up too. Please go ahead. AA.
Yes, sir. I just want. Okay, I don't know if I'm the first person to. Okay. Let me just go ahead. So basically, as regards the explanation you just gave now. For instance, a company is a group of companies, and one of the subsidiary is, from the auditor's perspective, the way you explained it, is having a going concern issue, and the management are basically pointing to the auditor that it's a going concern. It's going to continue, and they have the support of the group. Parents. What should be the necessary steps to be taken by the procedure, by the auditor rather, to align things in that regard?
Okay, fantastic question, and it's a practical question, so please take note of it, everyone. Now, I will provide a very clear context to that, because the group the auditor is auditing, the material subsidiary, has to be taken into cognizance, because let's say a subsidiary is about 70% of that group. It has 70% stake. The investment in the group, that major subsidiary is about 70%, has 70% control. So the challenge now is it's a major subsidiary. And if it's making losses and the group is making profit, the auditor is saying, this subsidiary I'm seeing, the crash of it will shake the holding, and the going concern status is low. But you are saying with the support of the holding, the subsidiary will pick up. Now, it now depends on the assessment of both management and the auditor in agreeing. So the auditor, in his judgment, if he finds out that the subsidiary cannot continue as a going concern, he needs to, number one, is to discuss. Then number two, check if materially that subsidiary's result will affect or distort the financial statements or impact on the financial statement negatively. He needs to bring it to their attention. And where they are not seeing it from his view, then he needs to consider it in his opinion, either impacting the opinion, qualifying the group's financial statement, or seeking legal advice. Now, don't forget, in group situations, you have the group auditor and you have the component auditor. Most of the time, you don't have the group auditor auditing all the subsidiaries. We always have component auditors addressing subsidiaries, associates, and all that. So the component auditor and the group auditor have to be in sync to some extent, though the overall responsibility of the group lies on the group auditor. We'll be coming to that in chapter 10, group audits. The overall responsibility of the opinion of the group lies with the group auditor. So if the component auditor and the group auditor are in alignment based on their findings, and they're telling management this subsidiary is going to affect the group, then his decision has to stand, and he has to override management by doing the necessary, because whatever reports he issued, his integrity, don't forget, is at stake. So in answering your question succinctly, number one is discuss with management. Number two, look at the impact on the financial statements based on this going concern status. And number three, where necessary, redress are sought and management refuses, then he needs to consider qualifying his opinion. That's it. Because if a company shuts down, a going concern company that the management has said blah blah blah, and something goes wrong in future, it's the auditor they will call and say, but the auditor has spoken on going concern and saying this business is going to be foreseeable in the future, and stakeholders could sue him for the report he provided or the opinion he signed based on this. So the auditors have to be meticulous on subsidiary, holding, company issues, and that is why audit of group are very, very critical around subsidiary and the main holding company in assessing going concern status, which is a prevalent issue in practice. So thank you for bringing that to the fore. So succinctly, number one, discuss with management. Number two, assess the impact on the group based on that subsidiary you discuss. And number three, he needs to act on it, whether to qualify the opinion or seek legal redress. This is very important. I hope you caught some thoughts on that.
Sure, very clear. Thank you very much.
All right, you're welcome. Thank you for that fantastic question. Oh, I'm glad we are done. This is good. This is good. So we could rest. I'm glad we finished the evaluation and review in one class, just 2 hours. This is cool. So thank you very much for your time. I'm glad I didn't overstretch us. Okay, somebody's hand is up again.